So this morning I'm going to be talking to you about that most exciting of things, legislation. At this point in the calendar, we are about 2 weeks away from where the second version of the Payment System Services Directive will be voted on by the European Parliament. And we expect that to go through fairly straightforwardly. So this is a great time at which to look at what the implications might be for us as corporate treasurers, potentially for banks, but certainly for us as payments professionals. Why should you be concerned? Well, I'm going to pull out a number of things. I'm not going to read through the regulation, which is over 100 pages of fairly dense legal text, fairly complicated. I'm going to pull out a few of the key points. And one of the points is the point that Catherine mentioned, which is around access to accounts, which has been given the wonderful hashtag XS2A. But there are some other key points for corporate treasurers and payments professionals, certainly around liability and who's liable in the case of faulty payment transactions. There are things it has to say about surcharging, so the fact that surcharging isn't common all the way across the European Union, the Payment Services Directive has something to say about that. It also touches on the area of security and how users should be authenticating themselves to the payment services they're using. And finally, of course, it changes the scope behind the Payment Services Directive. So if we cast our minds back to 2007, when the first Payment Services Directive came into force, that being a directive then took about 18 months or so to transpose international law. So even if the European Parliament voted it straight through with no changes at the beginning of October, that would still take up to 18 months or so to transpose into law in all the member states of the European Union. So we've still got a little bit of time to plan what we're going to do. So the first thing we're going to talk about is what the Payment Services Directive has created, which is a new market in being able to control corporate and indeed consumer bank accounts using what are called third-party providers in the most general term. Of course, when the European Union likes drafting legislation, it likes to include not only its main purpose, but to bolt something else on the side. So when we did the PSD in the first case, the Payment Services Directive, that was originally to create a new legal framework for payments. And the PSDII, again, established exactly the same thing. However, in the first version, it also extended to the regulation of payment service providers and the technical standards and the business models that they needed to abide by. And not to be left out this time, the Payment Services Directive version 2 creates these third-party providers in a market by which you may be able to go to organizations that are not your bank to be able to initiate payments and to view statements on your account, to actually be able to access account information. So as part of this new directive, we've created some new terms. We've created a new term of a payment initiation service provider. So that's an organization that may be providing you with a mobile phone app, a web app, something installed on your desktop, something running within your business, which enables you to initiate payments from your corporate or indeed your consumer account. And the basis behind which the European Union is doing this is to create competition. So it realizes potentially that you may not be getting exactly the payment initiation services you want from your bank or banks. And it may be actually there is a third party out there who would be able to initiate payments on your behalf in a better manner. So maybe there is a possibility of better integration with your ERP system. Maybe there's a better integration with your payroll system. And if you give permission to do this, and we'll talk about what exactly that means, then you may be able to initiate payments in a much more effective manner. In addition, the Payment Services Directive 2 creates another term, the account information service provider. So these are the entities which can go into your bank account, can look at the statements, look at the entries, extract them, maybe do some analysis on those, and then provide that information back to you so that you can potentially get a much better model of where you are, better benchmarking, maybe a better assessment of where your debt is. So they've created these two new service providers, and because they've done this, they've needed to create a new term, the account servicing payment service provider, which I suppose traditionally would have been your bank or your payment institution under the terms of the previous agreement. So the account servicing payment service provider is where your account is located. The payment initiating and the account information service providers don't hold your funds. It's the account servicing payment service provider which does. I know this sounds complicated. Believe me, it's much more complicated when you read it in the text. So this creates a new market, and that is being foreseen as being accessed by new APIs, and this is trying to open up, I guess, payments and certainly some parts of banking. So you as corporate treasurers may have new options on the way you access your accounts. So traditionally you may have your bank corporate bespoke type of access, maybe host-to-host connectivity, maybe online banking. You've probably looked at things like SWIFT for corporates, or maybe EBICs in some countries where that's available. This gives you a different means of access using your existing tokens. And we'll talk about authentication and the security of the process in a minute. Interestingly, because there are new organizations which are actually starting payments in the process, so when you type into your mobile application on your mobile phone, you authenticate yourself to your corporate bank, you press the button to make that payment, the payment initiating service provider is going to take some liability, and therefore they're going to be mandated to have some insurance to cover themselves just in case that's not viable. And therefore it's unlikely that these new payment initiation providers are going to be providing their services for free. But it may well be organizations that you already know, and we can certainly come back to that. So payment initiation and account information, two sides of a payment process, sending it out and receiving the information back in again. Hopefully with these APIs, or at least the way that the European Commission views it, that will make things much more efficient for us as consumers and for us as corporate payment professionals and treasurers. But the key point about this is, if we're going to open up this market, then we need to ensure that that is a secure market. We need to understand how and who is actually accessing these systems. So if I'm now saying, okay, you're not logging into the bank portal, therefore the bank can't necessarily decide whether you really are the user or not. If we're going to have some third party sitting in the middle between the user and the bank, then how are we going to run the customer authentication? How are we going to ensure that it really is the customer that's asking us to make these payments or asking us for information on access to those accounts? Well, the Payment Services Directive 2 covers this as well. So it establishes the need for what they call strong customer authentication. And we've had what we call strong authentication, and in previous versions of publications by the European Central Bank, that was viewed as being something like 3D secure, which isn't, in my opinion, particularly strong enough for corporate banking. Strong customer authentication now means three key things: something you have, something you are, and something you know. So the idea is that something you know, maybe your password, your username, something you have, maybe a token. I'm sure that we all have tokens to log into our corporate banking systems. But also, strong customer authentication is looking at something you are. So they're looking at biometric authentication as part of that process. And one of the restrictions, one of the requirements on the strong authentication piece is that there should be something which can't be replicable. So you couldn't say, capture those details and then replay those later on to have the same access to the account to send another payment of the same amount or a different amount back out to that corporate account. Therefore, strong customer authentication is actually really good for all of us. It'll establish for the first time common standards on how your bank knows who you are when you as a member of staff or you as a consumer want to make a payment. What's interesting is, of course, since the Payment Services Directive version 1 back in 2007 and here in 2015, we've had the creation of a European banking authority. And the European Commission's taken the opportunity to say, okay, well, we know that there need to be standards out there. What we'll do is we'll give that task to the European Banking Authority to look at, to establish what those standards should be. And therefore, we're looking at what those technical standards will become when we are authenticating ourselves to the bank. It's interesting that will go way beyond what we're currently doing. But that is, again, one of the areas of the PSD2 which is yet to be clear on how it's going to play out. All of the key things about this, especially with the initiation of remote payments, have already started to come into force. So as of December last year, the European Banking Authority published guidelines on the security of internet payments. And that requires what they term strong customer authentication, very much the same definition that the Payment Services Directive version 2 has built within it. Of course, they were guidelines, and those guidelines came into force actually on the 1st of August this year. Some countries have decided not to implement those. So the UK, for example, has said, well, we'll wait until the PSD2 comes out. And some other countries have adopted those and say, yes, all our payment service providers should do this. But I guess we probably haven't been impacted by that yet. Certainly, I'm not aware of any payment service provider that's gone out and issued new credentials to its customers so that it comply with those guidelines from the European Banking Authority. So it'll be interesting to see when exactly those credentials come out, what form they'll take, how the biometrics might work, whether we'll be using mobile devices, whether we'll be using bank-issued devices, whether they're USB tokens or smart cards or some other mechanism. But certainly one of the key things you're going to change is that drawer full of tokens you're using to currently access your corporate banking systems, well, that will either be supplemented by other devices, or it may move on to a single device, maybe potentially onto your mobile phone. So there will be a certain amount of change within your own overall business processes within payments and treasury. So in addition to the sort of changes, the new market it's created for third-party providers for access to data and payments, it also changes scope. And there are two key pieces of change to scope that I'd like to bring out. The first thing is, when the Payment Services Directive came in 2007, it wasn't clear whether payments on behalf of and receivables on behalf of was actually covered by the Payment Services Directive, whether a parent company providing payment services to its child company, whether those are actually covered and whether the information requirements, the transparency, the payment initiation requirements would actually apply to those types of transactions. Well, the good news is the PSD2 makes it very clear that those are out of scope. So if you were concerned before about moving to a POBO or ROBO model because of compliance with PSD, you needn't worry when the PSD2 comes in. And I would guess that once it's voted on, it will become much, much clearer and you won't be taken to court, I would guess, based on this new law which is coming in. You won't be in a position where you will be non-compliant. The other key change to the Payment Services Directive 2 is that it is also bringing into scope one leg in and one leg out transactions. Now, these are transactions which start outside the SEPA zone and transactions which end in the SEPA zone or start in the SEPA zone and end up outside. And that's for all the EU currencies of all the EU member states, whether they're Euro or non-Eurozone customers. Therefore, there's a significant increase in the amount of scope, and there are also a number of technical changes on how those payments should be addressed. To some extent, it gives member states a little bit more control over some of the identifiers, but it minimises the amount of uncertainty as to what's in and out of scope, especially around things like telecommunications types of payments and closed network payments. So it's a big, long document. I wouldn't recommend you read it. There are a number of really good analyses out there. Primarily, they've been initially targeted at the banking market because they're going to be the people first affected. But actually realizing how the banks are impacted, you can also see how it might affect your businesses as well. I can certainly recommend a couple of the InnoPay reports, which might highlight some of the things that may well change. Thank you.